Yo, yo.
Yo.
How you feeling, Tommy?
Oh, man, I'm good, bro. How you feeling?
I'm good, man. I feel like this week has been pretty good. The kid's been, I don't know, treating me nice. More nicer than usual.
Okay. Yeah, man, you know, I'm mad at you, bro.
What
We didn't
I
hoop
do?
last week. You was telling me that we was gonna go hoop, and
Oh,
I was ready to hoop. I was ready, man. I was ready.
yeah. So I went out of town, and by the time I
Go
got back,
ahead.
bro, it was like raining, wasn't it that day?
Go ahead. Yeah. Hey, just to the audience, Sean only hoops outside. Sean is cheap. He's about that bag. I even told Sean, I said I'll pay for it. He's like, nah. So all good, fam. All good though. I did kind of get it in this week, you know what I'm saying? Last week. I just been trying to stay consistent on my fitness and make it fun again. Right? Because sometimes I feel like it can just become kind of bland. And then I'm like, if I could socialize at the same time, that's golden. But I did go out, last weekend and socialize. So it was pretty cool, man. Your dog is getting outside, so
That's what's
shout
up.
out to that. But yeah, man, everything's been cool. Just trying to walk into formulation of my new systems and procedures. Sometimes it's like, okay, one thing slide, you're like, okay, I'm still ahead. I can still work through this. So it's been a good week. I think it taps into today we're talking about the 40-year mortgage. And I'm glad you brought this up because it seems like now every company has a credit card. Companies are going out of their way, and this is resembling the housing bubble. You know what I'm saying, from the 2000 we'll call it 6 through 2008, all the way through effects of 2010. A lot of people are still feeling those effects today. And one of the biggest problems is people see I can extend this out and it looks like we can afford it. And so today we're gonna dive deeper into what it looks like to afford these things, the pros and cons of a 40-year mortgage. It just sounds, if I'm being honest, bro, it sounds ridiculous for me to even say 40-year mortgage, right? Like it just don't even sound right coming out of my mouth. But I could be biased, right? We'll get into the facts. I could be biased because I'm not pro, compounding too much debt. You know what I'm saying? I'm not on the Ramsey side, so much, but at the same time, I'm like, you kind of gotta play with the resources you got. And 40-year mortgage just don't sound like we playing the game right. So we're gonna get into this video real quick, this clip that I found on TikTok about from Glenda Baker. And she kind of talks about, affording a house, you know what I'm saying, not becoming house poor.
A lot of people think that if you can afford a house that's X number of dollars, you're good to go. What most people don't realize is the upkeep and the total cost to own is what kills you on real estate. Let's say that you can afford a $300,000 house. You need to keep in mind, you still got to have gas, electric, water. You got to keep up the yard. You've also got capital improvements, and you can be assured that you're probably going to spend somewhere between 1 and 5% per year on capital improvements. So if you're in a $300,000 house, you need to have between $3,000 and $15,000 a year that you're going to spend on capital improvements, HVAC, roof, plumbing. And the thing about it is if you don't calculate that in your budget, you become house poor. Nobody wants to be house poor because your house gets run down. The value of it starts to depreciate if you're not investing in your house. So don't think that the purchase price is.
Yeah. And so that was dope, man. That was dope. And the reason why it was so dope was the fact that people don't think about making decisions in their entirety, right? People see a low car payment. They think, okay, I'm good. No, you got to think about insurance, right? You got to think about, deposits on those things. And I'm only referencing that because it's something that's a little bit more simple. But I was watching a video in an article. A lot of these people, remember we talked a couple weeks ago, we was talking about how regular car payments might be $800 or whatnot like that. People are paying, bro. They're paying $1,500 for a car payment, bro. Wait, what? You tell what? And in order to get in that type of situation, A, you buying too much vehicle, or B, you not being intentional and your credit score isn't high enough for you to be purchasing another vehicle. That's what makes it kind of, I'm like, man, it's real shocking. And so I want to kind of pick your brain on this. So when you were looking up this topic, what stood out to you the most? Why did you decide that you was going to chop it up on the 40-year mortgage? Oh, hold on, Sean. You muted, bruh.
My bad, I forgot I muted myself.
What made you? So what made you want to chop it up on the 40-year mortgage?
I didn't even know that a 40-year mortgage existed. Like, I didn't know at all. I thought it was only 15 and a 30. And then recently I found out that it's like a 20 and now there's 40. And I think it's a 10 too. I didn't know it was like different, years that you can get it on a mortgage. But then I read the article and I became very interested in if it was worth it. Because typically I only hear about the 15 and the 30, right? So, you say you're not, all in on Dave Ramsey, but I am. I pretty much follow it to a T, except for the credit card. I still got a credit card or two. But so what Dave Ramsey teaches, he says that you should have a 15-year mortgage, and it should be 25% of your income. Okay, like your mortgage should not go over 25%. So let's say you make $4,000 a month, right? Your mortgage payment shouldn't be more than $1,000 because 25% of 4,000 is 1,000, right?
Yeah.
Now people would be like, oh, like who can afford that? You can't buy no house for $1,000 a month or anything like that. But you got to do your research, bro. And this is a couple of factors we got to mention. You mentioned one of them, your credit score. What determines how much you pay in your payment is your credit score. The higher your credit score, the lower your interest rate. The lower your credit score, the higher the interest rate. Well, it's also a factor of your payment is how much you put down. What percent are you putting down? Typically, you want to put down 20% so you can avoid the PMI, which is like an extra amount of money that goes into your payment every single month, because the least you put down, the more risky you become. So someone who's only able to put down 5% is more risky than somebody who put down 20% or 30% to get a loan. And then the loan itself, the amount of the loan is also a determining factor in how much you're going to pay, right? Someone who has, so I'm going to just throw some numbers out there. So let's say we have someone with a credit score of a 600, right? Then maybe you only able to put down 2.5%, and then the total loan is $300,000, right? So 600 credit score is not that great. Putting down 2.5% is not that great, and a $300,000 dollar loan is about typical, right? So I didn't. You know what? I didn't even decide to even actually figure this one out.
Well, I got a chart. So when we get to the when we start looking at the 15, the 30, and the 40, I've got a chart that we'll actually pick up. We'll
I'm gonna stop right there.
We'll walk through the numbers because I've got it basically mapped out as far as interest, as far as total payment, and all that. So we'll get to that. But those are some great things that you talked about, because that pre-mortgage, that private mortgage insurance is something that they look for if you can't meet the requirements for the down payment. And the problem is a lot of these contracts you can't necessarily get out, and so one of my biggest things is as we walk into like the pros and cons, because you made some great points, right? You got to look at that credit, you got to look about how much you have, and and how much income you have in. Those things that you talked about with that income, they weren't relative to other things that they're already purchasing. Because usually most people, before they buy a house, they typically have some type of car or vehicle, right? And what a lot of people do is they'll get married, right? The marriage might cost them, the wedding may cost them $20,000 plus. I've heard some crazy numbers out there, as far as $100,000. So a lot of people are financing, those weddings, and then they go get the house that them and the wife want customized and all this crazy stuff, and they're not looking at homeowners fees and things like that. So you can really get in trouble when you start adding all these extra pieces and all these extra layers. And then you got to also make sure you got a solid partner as well. That's a tough call. So if I'm looking at, that's dope. So if you're looking at, the pros and cons, what is your biggest pro as far as the 40-year mortgage goes?
Let's see. I got 3 listed, but my biggest pro would probably be I'm gonna go with flexibility. My biggest pro would be flexibility, because lower payments can give borrowers more flexibility to save or invest money in other areas. So let's say you decide to go with a 40-year mortgage and your payment is lower than a 15-year or a 30-year mortgage every single month. Okay. With the money that you would basically use if you were to get a 15 or 30-year mortgage, you can now put into investments. So now your money is probably growing faster in some other vehicle like stocks than it would in a house. Okay. And I was thinking about, like, how would this look for an investor, right? So let's say you decide to go with a 40-year mortgage. As an investor, you like cash flow when it comes to real estate. So if your mortgage payment is lower, but you can raise the rent to, average or a little higher than normal, then that means that spread is more money in your pocket.
Big facts.
So I'm gonna stop right there because I don't want to go into the con.
Nah, you good. Well, and that leads into my pro as well. The lower mortgage payments. But like we talked about, you have to be intentional. While you're doing this, you have to be focusing on increasing your buying power with other assets that will possibly lower your payment, right, over time. But the thing that you have to look out for when you're trying to, make these moves, right? Say you get the other place, you get it paid off, you got income coming in, and you want to be aggressive because you're tired of that 40-year mortgage. One of the things that you want to look out for are the prepayment penalties, right? Because with the prepayment penalties, if you pay off early, you could potentially be charged. I remember when me, you, and Zora, we were sitting in y'all spot, and we were talking about different fees. A lot of times people don't look at those fees because what people typically want to, the people that are going to give you the loan, what they typically want to look at is, hey, are we going to be guaranteed to get this interest off this money? People and businesses don't loan money without looking for some type of interest. There is typically a what is in it for them. And if you're not meeting that bottom line, a lot of times you can start adding up these different penalties. Shout out to Zora. She said your credit score will also determine how much you've approved for, so you may only be approved for a certain amount based on your credit score, and that will determine the house you can buy and loan. Yeah, facts, man. Those Snapple top facts right there. We appreciate you, Zora. That credit score is everything. So, it was one of those things where I'm like, yes, could I pay this off early? But I also have to ask myself, we also have to ask ourselves, are we the type of person, if we need a 40-year mortgage, are we the type of person that is going to be intentional enough to pay off another home and then pay off this next home? I highly doubt it, but you could be the one. You could be outstanding, do what you do. But we want you to be informed that there are penalties that are attached to those. What is your con when we talk about the 40? What is your biggest con when we talk about the 40-year mortgage?
I would say my biggest con would be that you're building equity slower. So the longer loan term means it takes longer to build equity in your home. So if you got a loan for 40 years, typically they put all the interest in the first half of the payment and then the principal in the second half of the payment. So let's say your mortgage payment is $1,000. Okay. Like we said earlier, your interest payment, towards that $1,000 might be $700, while $300 is going to principal. So that means if you got a $300,000 house and you made, 10 payments, in your mind, you like, oh, 10,000 off of 300,000, I owe the bank $290, right? I'm sorry, 290,000. But the thing is, what if all of those payments for the first 10 years was only $300? Then really it's only $3,000 in those 10 months. So instead of you thinking you owe 290, you actually owe 297,000.
Yeah.
That's the biggest con.
Well, and that's a lot of times that's how they get them. They get people, you know what I'm saying, with cars as well, that interest, you know, over the life of the loan, and that ain't no joke. Because you look up, you're like, I've been making my payments, I've been calculating. I thought I was gonna pay it off in this. Like that's what happened with one of my first vehicles. I was like, oh yeah, you know, my first vehicle I paid for in cash because I got it at a basic. But you know, that second vehicle, I was like, man, this is a lot of money. And that third one, I got it from a lemon lot, you know what I'm saying? So I've been out in these streets, you know what I'm saying, doing some different things. But it's just crazy. Hey, shout out to Zora again. She said, depending on what age you buy this house, you may be passing that mortgage debt on to a family member. Yeah, that's facts. You know, because a lot of people, what they don't like to understand is somebody's got to foot the bill typically for that debt. And what people typically do is they, like a lot of the elderly, one thing they'll do is they'll think that they're doing their kids a favor by saying, I'm gonna write the home off, you know, to my kids. But a lot of times they're saddling them with debt, and they're saddling them with debt that's not valuable. There's no value in that home. I can't tell you how many corporate conversations and just you know, water cooler type conversations at different workplaces I've had where people are like, man, you know, they left me the house or left my uncle the house. I want them to do this and I want them to do that. But the problem is the uncle, he's the only person that got capital. But everybody wants some. And so a lot of these financial decisions, we talked about, you know, as far as finances and relationships go, but when it comes down to finances and families, a lot of things get really, really messy. And so we got to be very intentional about that. For me, you know, some of the biggest cons that we have are, you know, the biggest con that I see is the 40-year mortgage is not a qualified loan, right? So, and only 2%, like 2% of the population actually got 40-year mortgages in 2022. And so that was very alarming because it's like, okay, if this is not a normal thing, how are people getting fleeced? And so the qualified loan, when it comes down to the qualified loan, these loans are qualified by the CFPB, the Consumer Financial Protection Bureau. And so what they do is they protect, you know, individuals and try to educate people and protect them from scammers and fraud. And so your protections may be limited because the fact that a 40-year loan is not a qualified loan, right? Since it's not qualified, you may not be able to get the backing that you need in case you get fleeced, right? You may be stuck this loan because this is 40 years we're talking about. And we'll get to the numbers on the next bullet. This is 40 years you're talking about. This is 40 years of a payment you may never be able to shake. A lot of people don't live to see 40, right? But that a lot of people don't understand that a lot of your debt lives on if you don't have the ability to pay. And we already talked about this, like last year, I think we were talking about life insurance and things like that. A lot of people don't have life insurance. So there ain't no money coming out. And a lot of our communities are notorious for having bake sales to bury somebody and having a fish fry to bury somebody. So we got to think about, okay, what demographic is getting these 40-year loans? Why are they getting the 40-year loans? And what else goes into the bigger picture of, you know, taking on that 40-year loan? You know, it was just one of those things where it stuck out to me. I'm like, man, this thing ain't even protected. Like people gonna go out here because you know how they tell them. They be like, yeah, go get the LLC. Then you get the LLC. Then you go flip that. You gonna do this. And they're like, yeah, bro, go get that house. But we're gonna get into the numbers because if we look at the 15, the 30, and the 40, it's a whole different ball game. So when it comes down to factors to consider, what are you looking at as far as factors
go? I say a factor to consider is like your personal finance goal. Like, when do you want to retire? And this kind of goes back to the wifey's point when she said, depending on what age you buy the house, you may be passing on the mortgage debt to a family member. I was thinking, you know, depending on how much your mortgage is, you might not be able to retire at the age you want. Because if you do a 40-year mortgage, like, can you retire? Bruh. Can you retire with that payment? It depends. Like, did you put yourself in a position where you used as much money as you could when you was 20-something or 30-something, and now you 60, 70-something, and you still got that payment, right?
Bro, and a lot of people, they get in 2 jobs just so they can have 2 careers so they can continue to fund their life. Like, so it's like, okay, in the first 20 years, if we didn't make sound financial decisions, we had to go out and get another job to make not only even more financially unsound decisions, because a lot of people, they're like, okay, I can retire again in my 50s or 60s. But the problem is a lot of people that are doing that are going into second and third marriages. And their lifestyle is increasing because they want to impress that new partner to give them everything the old partner didn't get. So that way they can potentially have a better marriage and a better relationship. You know what I'm saying? So that financial decision, we got to really question, like, man, okay, this person, because I'm looking, they salivate. The people that's writing these loans for 40 years, they salivate, because that's a big paycheck for them. That's a big payday, especially because, if we're looking at this chart, we'll pull up this chart real quick. If we're looking at this chart, like a 40-year loan, you talk about interest that's almost 2 houses, right? You know what I'm saying? After you've paid everything off. Like once you topple up the interest and everything, you know what I'm saying, on there, like it's like paying for 2 homes. You could have had 2 homes already, right? Now, if you're intentional, you can be doing that, but I'm like, $300,000 is a lot of money. And, when I'm looking at this chart, we talk about, the borrowed and then, what I'm saying, but the interest added into it, you know what I'm saying? And people don't understand about this interest. It's not just on the payment. Like a lot of this interest, depending on the type of loan you get, it could be weekly or monthly, and sometimes even daily. So you really got to pay attention to those numbers, because simple interest you still got to pay interest for the life of that loan. The more you extend it out, the more you got to pay. And when I'm looking at interest, I'm looking at, okay, if you go longer term, here you got more interest. If you go shorter term, you have less interest. You know what I'm saying? Lenders take more risk with longer terms, and that's why they're going to charge you more, because they may not actually get their money. They're going to get their original money because you paid for it. Now they got that fee. We talked about this, you know what I'm saying, in your living room. The person that got their fee and you was questioning their character, like, hey, you just seem like, you know what I'm saying? What was the word you used? Was it a taker or a user? What was that?
Oh, the borrower is slave to the lender?
Yeah, because you was talking about the person's character, because you was like, you know what I'm saying, you was kind of, you know what I'm saying, staring down. It was like, why are you looking at me like that? And so it's one of those things where I start to question a lot of these people that's trying to, get over here, get this mortgage. I get selling mortgages and getting people in homes is your job, but I also want you to, do it effectively and do it in a way that works for the person. I actually did an interview, and it'll be airing this summer with a mortgage lender, talking about the steps that, like, they actually walked them through 6 months of preparing to buy the home and looking at how much their income is. Because even on the rental tip these days, they're looking at the numbers and saying, okay, can this person actually afford this? Like when I had to come out here to do the rent, to do my rent, they wanted like 3 or 4 times the amount of rent I had to make an income. So, that really had me thinking, like, okay, people they're trying to help you be more responsible. But just because they got that amount of money doesn't mean they actually have that amount of money, right? So, we got to be intentional. Hey, shout out to Wally. Hey, salute, fam. Fam said, I'm surprised it wasn't a 45 versus a 40. Yeah, fam. Like, and that's the part is like with that 45 and 40, it may be one day. Right, it may be one day, because the car payments are extending out as well. But I hope before it gets to that point, I don't wish that we have a bubble that bursts. But the problem is people don't pay attention to history, and then when they see the history, like, that could never happen to me. And so we got to be very intentional. So earlier you were talking about the numbers and things like that. What you got for us, man?
Now that you got the numbers in front of me, I get to make my point now. So imagine, you just have to go with that 40-year mortgage, right? And you like, okay, cool. I got a $1,650.64 payment. What are you doing with the rest of your money? That was the point I was trying to make earlier. So let's say you decide to get the 40-year mortgage. Your payment is $1,600, and you just blow the rest of your money for the next, 30 years, 40 years. And you look up and it's time to retire. And like, did you even pay off your mortgage? Like, did you end up refinancing and then taking the equity out of your home and then get another 40-year mortgage? Like, did you make mistakes along the way where you just blow the money, bro? Like, now you can't really retire because you got to pay $1,600.
Well, and the problem is, facts. Well, and the problem is, bro, is with the chances of you being able to refinance on a 40-year loan are going to be slim to none. You know why? Because you're going to have less equity in your home. So it's going to take longer to build equity. So by the time you build that equity, and you, like you said, you talked about the retirement plan. You won't have anything to flip or refinance. The interest rates may change. Now you want to refi, and you don't have the ability to do so. Now you're just stuck in a place that you might not even like. A lot of first-time homeowners, they're like, okay, this was a cool little stint, but I'm gonna reduce down later, right? But if you stuck in a 40-year loan, and a lot of people, they base it on, I want to raise a family in this amazing home, right? But eventually that family grows up and they leave. Mm-hmm. And we're finding less and less that people want to take on their parents' burdens because they want to get on and start on their own burdens. Yeah, I said it. Not necessarily their own success journey, but their own burdens, right? So because in society, a lot of times we're a selfish society. So we're looking at, okay, what can we do? I don't want what they had because that just wasn't good enough. And so, but what the elderly typically does is they want to move to places like Florida. They want to, move to places like Texas, you know what I'm saying, where the taxes are different, where the weather might be nicer, right? But the problem is they're saddled with this 40-year loan that they can't get out from underneath, and that's what's gonna hurt them. But it's just crazy. I could probably cook on this all day. Mm-hmm. But before we wrap up, did you have any more points on the 40-year loan?
I'm gonna say one more thing. Like,
it don't even sound right.
You said what?
40-year loan don't even sound right, bro.
It don't.
Go ahead. Sorry, I'm bad.
But this is the point I want to make. We had a conversation about cars, right? Uh-huh. And having those payments forever. And now we got these 40-year mortgages where you basically having a payment forever. Mm-hmm. Think about all the interest rates that is coming out of a car, a house, mm-hmm. and anything else you paying interest payments on, probably your student loans, right? Mm-hmm. If you don't get this debt out of your face, you're going to be paying interest payments forever. All that money could have been putting it into your own self, like your own accounts, a savings account, investments accounts, maybe your children's future. Maybe you want to do, 529 or whatever, college savings plan. Mm-hmm. But because you chose not to ever pay off anything and have payments forever, then your options are limited.
Oh, extremely. Because we were looking at the 40-year loan, the difference in like the total that you were going to pay, right? Not only was you going to pay the $300,000, you were going to pay, say you go to the life of the loan, you were going to pay almost $500,000 more for a $300,000 home. Mm-hmm. That's scary. And most people will never even make, in a year, 100,000, 120,000, unfortunately. And you're going to saddle yourself with something like that when you could have used that money to invest in yourself to get your bag up. All types of certifications. I know people, they don't want to pay, $400, $500 for a certification and a test that's going to increase their income and possibly triple it, right? We just got to be intentional, bro. It's foul out here that they even got this 40-year mortgage out here, bro. I really hope and I pray that y'all don't go get it. Look, hey, this ain't financial advice, but all I'm saying is you going to look crazy saddled in that 40-year home and everything that you plan don't work out. We got to stop looking at hope and start living in reality. So, without further ado, this has been another episode of Bag Talk 101. We appreciate y'all. I'm Tommy.
I'm Sean.
And this is FX2GL. Appreciate y'all.